So this week I wanted to take a look at what was happening with some of the Mag 7 names, particularly Meta and Oracle. Their stocks have fallen rather dramatically over the last couple of weeks. And I wanted to show you an example of fundamentals finally catching up to stock prices. Because I think a lot of times this stuff is overlooked and everyone thinks, oh, well, fundamentals don't matter. And they always don't matter until they do. And in this case, what's very clear from this latest earnings period is that when we look at these companies on a trailing 12-month basis, free cash flow has completely rolled over for Meta, and in Oracle's case, it's actually turned flat out negative. And when you look at Amazon, it has also rolled over. The only two that continue to see positive free cash flow growth on a trailing 12-month basis right now is Microsoft and Alphabet. Now, for full disclosure, I own Microsoft, Alphabet, and Amazon, although I've trimmed my positions over the last year in both Microsoft and Alphabet. But what I think is really important is that this trend that we're seeing is only expected to actually get worse, and the trend that we're seeing in Microsoft and Alphabet is actually expected to reverse. What we see here is the free cash flow estimates, not for the next 12 months, but for the next 18 months. And in all 5 cases, you can see how the free cash flow estimates have all turned lower, and in Oracle's case has turned more negative. And so I think that this is important because, again, we're seeing this develop in the marketplace, and you're seeing it specifically in the way the stock prices are acting. But before we go any further, please remember to subscribe to this channel, like this video, share it with your friends so we can continue to grow a subscriber base. And one of the reasons why we've seen free cash flow turn negative or is expected to turn lower in the coming 18 months is because Capex has really ramped up for these companies over the last couple of years. Specifically, when you start thinking about Amazon and Meta and Microsoft, they're spending a lot on AI infrastructure, and Oracle and Alphabet too, obviously, and they're all expected to spend even more into the future, and this is what's driving free cash flow estimates lower. And we have to remember that the market, for the most part, has kind of held a lot of these stocks on a pedestal because they've always been viewed in a way of like almost as if they're an island unto themselves, able to drive large efficiencies and free cash flow and generate revenue, almost totally agnostic to what's happening in the rest of the economy. And so now we have to start thinking that maybe the market is starting to change that point of view. And one place you can really start seeing that is in the credit market, in the credit default swaps for these different companies. You can see that more recently, the credit default swap for Oracle has gone from around 40 to 85 just in the last couple of weeks. And in the meantime, we've also seen similar movements in the price action for Microsoft, which has gone from a 13 to a 26. Again, these are fairly low numbers, but it's not necessarily about the absolute number, it's about the direction and the rate of change. Amazon moved higher as well. Now, Meta doesn't have a credit default swap. It just looks like it came public more recently, or at least that's all I have the information for, and you can see it's trading around 41, which is higher than both Microsoft and Amazon's, and Alphabet recently came with one as well, and that looks like it's only trading around 29 or 30, and that also has been trending higher, but again, we don't have a lot of data there. But you can also see this even when you go into something like a CoreWeave, which has seen its CDS also come more recently and is trading at over 500. Again, these all vary the debt they have on their balance sheets and such. But I think what's important, though, is that what you're seeing is not only a re-rating in these names, but you're also seeing a re-rating in the entire IG space, because obviously if you're going to see the leaders of the marketplace see their credit default swaps rise, well, then you're going to see a repricing across the entire marketplace. And what you are seeing is the IG index, CDX IG index, actually beginning to see its spreads widen a little bit. Again, these are very tight spreads historically, so it's not like it's a red alarm for anything bad about to happen. But what it's really telling us is about the direction of the overall spread itself. And this matters to some degree because we know that when we look at the S&P and we look at the market overall, when we look at things like the earnings yield of the S&P 500, it basically trades with, and we've talked about this before, it trades with the direction of credit default swaps, and it trades with the investment grade pricing, and it also trades with high yield grade pricing. And so if we start seeing investment grade and high yield grade pricing widen, then that's going to lead to higher earnings yields on the S&P, which means lower PE multiples, multiple contraction, lower price. And this all kind of goes together, and this is sort of what you're seeing taking place in some of these names. This is the reason why you've seen some of the weakness that you're seeing in some of these names. Again, if you look at an Oracle CDS and then you compare that to the Oracle price, what you'll see is that the price of the underlying stock has gone in the opposite direction of the CDS. So the wider the CDS prices, the lower the stock is going to go. And so if you continue to see the CDS move up in rate, then you're in the spread, then you're going to continue to see the price of the underlying stock also decline. And again, it's not probably by chance that you're seeing the same type of weakness developing in Microsoft, which has seen its price come down as the CDS has moved higher as well. So this is important stuff to really pay close attention to. I mean, you can roughly use something like the LQD to get a sense of what's happening in these markets. HYG also obviously has been fairly weak more recently. You can look at them on an adjusted or an unadjusted basis. I don't really have a preference. I just always try to make sure and remember how it is that I'm looking at it. But again, this is one way to do it. Another way to look at it is to look at the ratio of the SHY to HYG. This will give us a good sense of what's happening with credit spreads as well, or SHY to LQD. This also can give us a good sense, and you can certainly see that the SHY to LQD ratio has been rising. And again, this is a good sign of what's happening with credit spreads overall. And there are some other free resources available that are out there that you can use, like like some of these ICE B of A numbers. ICE AAA US Corporate Index Option Adjusted Spread has also been rising some, and then you also have the ICE B of A US High Yield Index Option Adjusted Spread. And all of this also matters because we know that implied volatility also moves right along with what's happening in these credit spreads. So it's not surprising to see some of these credit spreads widening and implied volatility moving up in the index as well. Anyway, please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again next week.